Take a look at this chart tracking the US S&P 500 and the UK FTSE 100 over the last year. Both indexes are charting an aggressive, continuous upward trajectory, consistently hitting record-breaking highs. At the exact same time, hundreds of billions of dollars are aggressively pouring into the rapidly expanding AI sector. For the average retail investor, the stock market looks like a machine generating easy, low-risk wealth. Wall Street and retail traders alike are operating in a state of extreme complacency. They are pouring money into these markets as if real-world macroeconomic risks have vanished entirely. But the Bank of England's regulators are losing sleep. Sarah Breeden, the Deputy Governor and Head of Financial Stability, recently went public with a strict warning. She expects a major market correction. Central bankers are specifically trained to project total stability. They use careful, heavily sanitized language to keep markets calm. A top-tier central bank regulator stepping up to bluntly sound the public alarm like this is a highly irregular and shocking event. Breeden identifies a dangerous disconnect. She argues that current asset prices simply do not reflect the scale of the risks facing the real economy, risks she firmly believes the stock market is currently overlooking. This leaves us with a terrifying question. What exact data is the Bank of England looking at that the euphoric stock market is completely ignoring? The first visible shock is geopolitical. The escalating conflict in the Middle East is severing global supply lines, and the International Energy Agency warns this could trigger a historic energy supply shock. Second, international trade networks are fracturing. Driven by aggressive new international tariffs proposed by Donald Trump, global trade wars are creating heavy economic friction. Third, there is the AI investment frenzy. Bill Gates explicitly compared the hundreds of billions of dollars being poured into unproven AI infrastructure right now to the late 1990s dot-com bubble, a period where investors threw money at unproven tech companies and lost everything. Any one of these individual shocks will damage the economy, but the Bank of England's nightmare scenario relies on mathematical probability. They are preparing for all of these separate risks to crystallize at the exact same time. Breeden's deepest concerns focus on the hidden dark matter of our economy, shadow banking. Let's look at how this system operates. This diagram compares a traditional bank to the private credit market. While traditional banks have distinct regulatory checkpoints, private credit operates entirely in the shadows, lending directly to businesses. Over the last 20 years, this unregulated pipeline has ballooned from virtually nothing into a $2.5 trillion economic pillar. Unlike the traditional banking sector, this shadow system has never been stress tested at this scale, and it severely lacks basic financial liquidity safeguards. This $2.5 trillion unregulated credit system is highly unstable. If panicked investors suddenly demand their money back, the entire pipeline freezes. The Bank of England sees an exact chain reaction forming. It starts when those surface shocks, energy limits, tariffs, and an AI bust hit simultaneously, forcing stock prices to fall sharply. That sudden drop destroys household wealth and business confidence. The fear quickly bleeds into the shadow banking sector, triggering widespread panic among private credit investors. Because private credit funds lack liquidity and are already carrying hidden losses, they cannot pay out. To survive, they are forced to lock up their capital and heavily restrict investor withdrawals. This single action is the tipping point. It takes a painful stock market correction and mathematically converts it into a catastrophic, systemic seizure of the entire financial grid. When the private credit market freezes, lending across the entire economy halts. Everyday businesses suddenly find it impossible to raise the funds they need to operate. Without access to capital, those businesses slash their budgets. That directly causes severe, immediate drops in employment and consumer spending for the working class. The mechanics here are nearly identical to the 2008 global financial crisis. We are looking at a massive web of deeply interconnected risks, kept hidden from regulatory view. The fact that a regulator is now identifying these interconnected flaws means a market crash is no longer a fringe theory. For the Bank of England, it has become a systemic risk that requires immediate contingency planning. The government and central banks cannot afford to rely on reactive bailouts after damage is done. They have to pull the shadow banking sector and the private credit market out of the dark and force them under strict, transparent oversight immediately. Contingency plans must be enacted before the bubble bursts. Waiting for Wall Street to fail again guarantees